afternoon, friends. In the lecture series on derivatives, today I'll be talking about the types of options, call option and put option. There are two types of options. One is called the call option, which means right to buy. The other is called put option, which is called right to sell. What is call option? A call option provides its holder a right to buy a specified asset at a specified price on or before a specific date, right? So this call option is bought when the buyer of the call option exercises the right in the underlying asset's price, expect that rise in the price and thereby buy that asset. The seller has the obligation to sell. So a call option is exercised when the stock price is greater than the strike price, right? For example, let me take an example so that you can well understand what this call option means. Supposing the current market price, that is the spot price on the NSE, National Stock Exchange, of SBI share is 450 rupees. Friends, this is just an example, right? So I'm presuming that the current spot price in the stock exchanges of the State Bank of India share is 450 rupees, right? The largest public sector bank, and I'm presuming the price is 450 rupees. And an investor expects that the price of SBI will go up and hence buys a call option. We also call it long call. When the party feels that the buyer feels that the price will go up, then he buys a call option. So the option holder feels that the price of SBI will go up. So what he does, he buys the call option of the SBI share, and the strike price is rupees 475. Means he buys the call option of SBI share at the rate of rupees 475. And for this, in my previous lecture also I said, call holder, that is a buyer of the call option, has to pay, or buyer of the option has to pay a premium for buying this right. So I am presuming that the premium is 5 rupees and the expiry date is after 1 month, right? So the current price in the market is 450 rupees. The contract price is 475 rupees. The premium which the option holder, that the buyer, pays to the seller is rupees 5 and the expiry date is 1 month, right? So if this is the condition, what will happen? What is this call option? How this is exercised? Let me take a different scenario, that when it is beneficial for the call option holder to exercise his right, or when it is not beneficial for exercising the right. The important thing is, what is the strike price? Strike price is 475 rupees. It means call holders make a contract to buy the stock at the 475 rupees. Friends, you may think that the current price is 450 rupees. Why the buyer is buying at 475 rupees? This contract is not for the present day. It is after for a month. And the buyer is expecting that the price will go up. So it may, the day of expiry after a month, it may be 500, it may be 600, right? So the benefit is unlimited, maybe 1000 rupees. So the benefit is unlimited. So what it does, in advance, the person makes a contract by paying a small premium. The option holder, that is the buyer, pays a premium, and this premium is 5 rupees, right? And as I said, that these contracts are of a standardized size. Suppose the size of the contract of option in the case of State Bank of India determined by the National Stock Exchange is 1000 shares, to keep the calculation simple, right? But here I will be showing you only with the help of 1 share. Supposing on the day of the expiry, the stock price is 460 rupees. Will the option holder exercise his option? My answer will be no. Why? Because the price is 475 rupees and the current price means on the day of the expiry, the price at the time is 460 rupees. So if the market price is 460 rupees on the day of the expiry, why the option holder will buy the share at 475 rupees? So what he will do, he will let the contract elapse right? He will not exercise his right to buy the share at 475 rupees, right? So what will be his maximum loss? Maximum loss will be 5 rupees on each share. If it is a lot is of 1000 shares, so maximum loss will be 5000 rupees. So his net gain or loss on each share is 5 rupees. Supposing it is 470 rupees, again the option holder will not exercise the right, because the current price on the day of the expiry, right? I am supposing it is 1st of July. On 30th July there is an expiry. So on 30th July, if the price is 470 rupees, the option holder will not exercise the right. Her or his loss will be 5 rupees, and on each share, if it is 1000 share, 5000 rupees loss, right? If it is 475, still he will not exercise the right, because the price is equivalent to the market price. So he will let the contract lapse and the loss will be 5 rupees. If the price is 480, then he will exercise the right, because so that he becomes break even. The current market price is 480 rupees. The contract to buy the share is at 475 rupees. It means the option holder is getting a benefit of 5 rupees if he buys the share at 475 rupees and the current market price is 480 rupees. Thereby he will make the profit of 5 rupees on each share. Since he has already paid premium of 5 rupees, so it means at 480 rupees the option holder will be break even. No profit, no loss. The benefit accrued or benefit arising to get the contract fulfilled is 5 rupees on each share, and the premium paid is also 5 rupees. It means it is a break even point. If the price on the expiry day is more than 400 rupees, any price more than 480 rupees will be beneficial for the option holder. Supposing on the expiry date the price is 500 rupees, right? So in that case, option holder will exercise his option. He will ask the seller to get the contract fulfilled, right? And thereby he will make a profit of 25 rupees per share, right? Because the current market price is 500 rupees. The strike price or the price at which the contract to buy and sell has taken place is 475 rupees. It means the buyer, that is the option holder, has a benefit of 25 rupees on each share, and the buyer has already paid a premium of rupees 5. So on each share the net profit will be 20 rupees. Suppose the price becomes 600 rupees. So in that case the profit will be 125 rupees on each share. 5 rupee premium has paid, so 120 rupees premium. So this way the benefit to the holder is infinite, means it can be to any extent. Suppose it may become 1000 even. So benefit will be difference between 1000 and 475, right? So this is the case of the P of long call option. Long call option means where the option holder has taken a right. In this case, whatever the price difference is, seller will have to pay for it, right? So this is through this table I have tried to show that when it is beneficial for the holder to get the contract executed, any price which is less than 480 rupees, right, will be, the option holder will not exercise the right to get the contract fulfilled, right? It will let the contract lapse. At 480 and above, the option holder will ask for, or he will exercise the right of option, right? The same thing we have tried to show through figure only, right? So what you are seeing is that on the x-axis means there is this right profit or loss, right? The share price, as you move to the rightward side, the share price goes up. As you are seeing here, at 475, which is a strike price, and 5 rupees is the premium. So any price which is less than 480 rupees, the option holder will be a loser, right? At 480 rupees, as we have seen with the help of the table, the previous table, at 480 rupees, it becomes break even for the option holder, no profit, no loss. The same thing we have tried to show through this figure, that at 480 rupees, there is a break even. If the price at the day of the expiry, friends, mind it, we are seeing with these tables or this figure is showing on the day of the expiry. What is the current price on the day of the expiry? any price which is less than 480, the option holder will be a loser. Loser in the sense that the premium which he has paid, that will be the loss, the 5 rupees on each share. If the lot is of 1000 share, 5000 is a loss. That's why this line is you are seeing is horizontal, right? So maximum loss is 5000 of the holder. But if price goes beyond 480, then you can see the profit is unlimited. Means higher will be the price, higher will be the difference between the break-even price, that is the strike price 475 plus premium 5 rupees, 480 rupees is the cost, right? So 480, any price which is more than 480, there will be benefit to the option holder, right? So this is basically the through this figure we have tried to show when it is beneficial for the option holder to exercise the right of the option, right? The option seller has under an obligation, he will have to get the contract fulfilled. Like the call option, the other type of option is called put option. In the call option, the holder, that is the buyer, buys the right to buy a share, right? In the put option, the option holder gets the right to sell the share, sell the stock. When I am using the word stock, it doesn't mean only the stock, means whatever the underlying asset is. It may be stock, it may be index, it may be commodity, it may be exchange rate, it may be interest rate, depending on the type of underlying asset for which you are making a options contract, right? So a put option provides its holder a right to sell the specified asset at a specified price on or before a expiry date. Means unlike the purchase, it is a case of sale. A put option is bought when the buyer of the put option fears a decline in the underlying asset's price. Means the holder of the put, that is the put option, is exercised by a holder when the option holder feels or expect that the price will be decline, price will fall. Means suppose the person is bearish about the stock, person is bearish about the market, right? So what he will do is he can buy a put option of the index, or if it is a talk of the underlying asset is in stock, so what he does is that he buy in underlying asset that is in form of share. So like the call option, which is a right to buy, the put option is right to sell. The seller has the obligation to buy, right? Seller has the obligation to buy. Means what I am saying obligation to buy means when the option holder has right to sell, so the other party will have to buy. So the option writer, that is the seller, will have to buy that stock, right? So one party is a buyer, the other is a seller. So in case of put option, the option holder is getting a right to sell the stock. So option writer will have to buy. This means a put option is exercised when the stock price is lower than the exercise strike price. So we will show you through the example when the put option is exercised. Let us assume that the current market price, that is the spot price of SBI share, if I am talking of today on the NSE or the BSE, right? The stock price of BSE of the State Bank of India on BSE or NSE is 450 rupees. An investor expects that the price of SBI share will go down, and hence he buys a put option, long put means buying a put option at a strike price of say 440, means 450 is the current price, at 450 strike price he buys a put option by paying a premium of ₹5, and the expiry date is after 1 month. Now the way we calculated the call option, similarly we are showing you that with the help of the put option, with the help of this table, that when it is beneficial for the put holder, that is the buyer of the put option, to exercise the right, and what will be the gain or the loss to the put holder, right? Means the option holder of put option. Supposing the price is 425 rupees, right? So option exercisable, whether the option will be exercised? Yes, because the price is, what is the current price? The price is 440 rupees at which the deal has taken place. So what he will do is the option holder will sell the stock at 440 rupees. The current price in the market on the day of expiry is 425 rupees, right? So thereby the same stock which is currently trading at 425 rupees the put option holder will sell this stock at 425 rupees, right? So it means there is a profit of 15 rupees, right? So premium payable is 5 rupees, so net gain or loss is 10 rupees. If it is 430, right? So the profit or the loss will be 10 rupees, the premium paid is 5 rupees, so the net gain will be 5 rupees. At 435 rupees, right, the person will become break even, because the current market price is 440 rupees and 5 rupees it has already paid a premium, so this is 430 rupees. If at 450 goes up, he will not excise the price, because then why he will sell the share at 440 rupees, since the current market price on the day of the expiry is 450 rupees. He will not excise his right to sell the stock, and it will get the put option lapse, right? So at even any price which is more than 435 rupees, right, will not be exercised. Put holder will not exercise his option of selling the share, because it will be better to sell he will not sell in the market at a price which is more than that, right? So this way, the same thing we have tried to show with the help of a figure. See, any price which is more than 440 rupees, it's a loss, right? Because the strike price is 435 rupees, the break even will take place at 435 rupees. Loss is limited to the holder. What is the loss? 5 rupees per share. If the lot is of 1000, for put holder, maximum loss is 5000. If the price is below 435, right, 425, 430, then only it is beneficial, right? So any price which is less than 435, it is beneficial for the put holder to exercise the put, right? Any price which is more than 435 rupees, the put option holder will not exercise the right, and the loss is limited to the extent of 5 rupees per share. This way, friends, call option and the put option works. Reverse will be the case for the seller, right? Supposing the price falls 435 rupees below, then, but put option writer will have to buy the share at 440 rupees, right? Market is giving the same share at 400 rupees, but since the put writer has made a contract, has given a right to the put holder to buy the share at 440 rupees, to sell the share at 440 rupees, right? The option seller, means the put writer will have to buy the share at 440 rupees, even if it is available in the market at less than that, because the person has already taken the premium for it, right? So this will be a loss. There will be a loss to the put writer. Options can be classified in 3 categories known as moneyness. Means what we are talking now is that there are 3 different situations, rather I would say, in the money, out of the money. Let us talk one by one. These 3 categories are in the money, out of the money, and at the money. What this means? In the money means when it is a beneficial to exercise the right. It is used as an indicator to decide if the option contract will make money if it were immediately exercised. I was talking about the put option, and from the put holder point of view, if the stock price of the State Bank of India is less than 435 rupees and the price is 440 rupees at which the contract has taken place, so it is beneficial for the put holder to get the contract fulfilled, right? So in this case, he will be in the money, because he will be getting benefit for getting this contract exercised. That situation is called in the money. It is used as an indicator to decide if the option contract will make money. Make money means will make profit if it were immediately exercised. It means option holder can make profit by exercising the right. That situation is called in the money. Out of the money, when there is a loss, it means option need not be exercised and get lapse, right? I am talking from the point of view of the option holder, buyer point of view, not from the seller point of view, right? Because when the buyer get the contract exercised, it is only when it is beneficial. When it is loss, the buyer will not enforce the contract, because it is up to the buyer the option holder, whether put option or the call option, to get the contract fulfilled, because for getting this right, the option holder has already paid the premium, right? At the money means break even. It means there is no profit or loss. That situation is called at the money, right? So this is call and put option relationship we have shown through the help of a table, right? Call option in the money, call option money. This actual price is greater than the strike price, right? So in the case of put option, out of the money situation will be there. In the call option, in the money, call will be exercised. If the actual price is equivalent to the strike price, so put option will be at the money. In the case of call option, at the money, right? Indifferent. So this is basically the same thing which I discussed. There are options can also be classified as an American option and the European options, right? Most of the stock option in India, we call it the American options or the European options. Let me talk what is American option. In the American option, the option holder can exercise the right to buy or sell at any time before the expiry on or on the expiry date. However, in the European option, the right can be exercised only on the expiry date and before, right? So in the American option, the option holder can exercise the right to buy or sell at any time before the expiry also. But on the date of the, but in the case of European option, exercise is exercised on the date of the expiry. The possibilities of early exercise of right makes the American option to be more valuable than the European option to be option holders, right? In the case of European option, on the day of the expiry, the contract will be exercised, right? But in case of American option, any time before the expiry date, the option can be exercised. In India, the stock options in individual shares are American options, while the index options, that is the Nifty and the Sensex options, are European options. So the American options have greater profit potentially than the European options. So these are also the different types of options, index options, the stock option. Index option means where you are buying or selling, means the call option or the put option is being used for a whole of the index. Like in the case of BSE, I would say the Sensex. In case of NSE, the Nifty, that is called index option. The stock option means where the underlying asset is in stock, particular share. Like I was talking of just now, I was talking about SBI share. So underlying asset is State Bank of India. Underlying asset may be Reliance or any stock that is being listed on the NSE and that is being covered in the derivative market, right? Similarly, there are currency options. Currency options where the underlying asset is the currency, dollar rupee or dollar rupee. You are making option, taking a option, call option or the put option of a particular currency to buy the dollar or sell the dollar. Similarly, the options may be of interest, that is a rate of interest. These are the different options. So index options is an option where the underlying asset is an index such as Nifty or Sensex. In India, SEBI has allowed a European option on Nifty and Sensex. Stock options on the individual shares are known as stock options or equity options. In India, SEBI has allowed American option on stocks listed on exchanges. Not all stocks which are listed on, there is a list of which the derivative market is allowed in the stocks. Similarly, the currency option. In case of currency option, the underlying security is a foreign currency such as US dollars, euro, right? Interest rate options. In case of interest rate option, the underlying asset is a particular interest rate such as repo or MIBOR. Repo means the repo rate that is being determined by the RBI. MIBOR is a Mumbai Interexchange rate, right? So these can be the interest rate options. So these are the different types of options that are prevalent in India. Thank you very much.